first rates will just start coming up on your screen. First rates any second now. You got a flat start for the Nifty and a flat start for the Sensex. Not too many newsmakers, I'm afraid, so it's not going to be news heavy Wednesday morning. But you got a 13-point cut on the Nifty, and you got a perfect market breadth. HCL Tech is powering along smartly, UPL is powering along smartly, Apollo is looking strong, HDFC Bank is recovering from that abyss it had hit on Monday. So it's a good start, it's a decent start, and it's a start which just does not change the big picture, so to speak. I want to look at the real heroes now. Tata Motors has been a very smart outperforming stock. As Tata Motors picked up from where it left yesterday, it's not a bad start. IDFC Twins, again, this is where the market direction has changed. RBL Bank, suddenly markets feel that all the concerns are behind. So RBL Bank yesterday had a good start. And then let's not lose sight of Yes Bank, which yesterday, being a two-digit stock, got a lot of action and attention. Yes Bank is now 16.5. 22 became 13. 13 has become almost 17. It's been a good comeback for Yes Bank from the recent.
Let's see what Tata Power is up to. Considering they've got that temporary relief coming in, that stock will just come off for you on your screens. Remember, the centre has issued and asked the company's Mundra plant to generate and sell power under Section 11 provision, so that acts as a bit of a relief. Although you're not seeing a reaction to Tata Power, still flat as we speak right now. Pharmaceuticals, that's the one space which has been a buzz. There's Mankind Pharma IPO as well, which is going to open on 25th. Lupin, Biocon, Divi's, Cipla, they all were holding a buzz in trade yesterday. Today it seems like they've hit a bit of a speed breaker. Zydus Life, they've got the final US FDA approval for one of the transdermal systems that they've been working on. That stock not seeing much of a reaction. Piramal Pharma, though, has got the US FDA issued an EIR for its Sellersville manufacturing facility. Piramal Pharma gaps up about 4.6%, 75.22 is where that stock is. There's Bank of India as well. Has approved fundraising of about 6,500 crore rupees for FY24. Bank of India 1.25% higher. There's eClerx as well, which has appointed Kapil Jain as CEO of the UK subsidiary from May 1st. Now remember, Kapil Jain actually comes from Infosys. So in that sense, eClerx, a stock in focus, holding up 1.5% as we speak right now. The government, remember, has increased the windfall tax on crude to about 6,400 rupees per ton from nil. That would not spell as good news for ONGC, but good news for Reliance Industries. So both those stocks in focus right now. There's also ICICI Lombard, wherein the net earned premium has come in below estimates. Tata Coffee, the EBITDA for the fourth quarter is down 5%. Margins have slipped more than 200 basis points as well. So these are some earnings disappointments coming in. But Kunal, for the index, it's absolutely flat. What do you do next? And what trades are you punching in?
Yeah, Aisha, I think it's going on expected lines. That we expected the indices to remain flat over the last couple of days, and that's what the indices are doing. In terms of individual stocks, there are, I think AB Capital is something which I've highlighted last week as well. Looks extremely attractive. The stock has managed to dip back slightly from that 166 levels to 163 yesterday. So that's an attractive territory where I would look to buy. I think it's a very attractive chart. The stock has confirmed a breakout on multiple time frames, so that's a stock which I would look to buy.
Saurabh Mukherjee joins us now. Let's connect with him. Let's understand his understanding of the market. When we spoke to him last, he did share with us that he's aggressively using the market decline to his advantage to add more stocks. Saurabh, good morning. Thank you for joining us. Let's start with your market view. It's been a good comeback for the market. All the concerns, one by one, they're getting addressed now.
I would say as much as with Nikunj. I think I remember a couple of very sort of grim interviews you and I did 2 or 3 months ago, where I think you were asking me and I was sort of confirming the fact that life was difficult for investors in the Indian market like myself. But I think the last couple of months, the peaking out of inflation globally, both in the West and in India, inflation does seem to have peaked. The fact that the interest rate cycle globally also seems to have peaked, the return of foreign investors, and all of that combined with solid macro and stock-specific news flow. Right, whether you look at doubling of power demand in India over the last 5 years, solid numbers from in terms of cement volumes, credit offtake, and sparkling numbers from say an HDFC Bank or a Bajaj Finance in terms of loan growth, I thought TCS's numbers actually were very, very impressive. So big companies reporting solid numbers, good macro, good inflows from foreigners coming through. I would say this is the best situation I have seen for Indian investors for a long, long time.
I was just looking at data. Asian Paints is saying that they are getting into waterproofing. Pidilite is saying that we are getting into paint companies. And I'm confused here. Pidilite is challenging Asian Paints. Asian Paints is challenging Pidilite. Who will get it right? Who will get it wrong? Both are your portfolio companies.
So I think one challenge there, I would say, is Pidilite has lots of ex-Asian people in it. And these are all very competitive, very bright, driven executives. So there's a little bit of, it's an old boys club fighting it out with each other. But on a more serious note, Asian Paints' waterproofing is for the inside of the building. Pidilite's waterproofing, primarily Dr. Fixit, is for the outside of the building. So whilst it feels like it's two giants punching it out in waterproofing, in reality, the core markets that the two firms are targeting in waterproofing are quite different. The head-to-head competition actually is quite limited. These companies are, I think, too smart to go head-to-head at any serious level. There is a little bit of don't come into my turf. If you come into my turf, I'll go into your turf. At the simplest level, think of Asian Paints as waterproofing for inside your house, inside your bathroom, and Pidilite as the waterproofing for the outside, the exterior of the building.
Saurabh, there is a renewed concern about IT. Now, I remember we were using words like a cloud lake is getting created, the cloud architecture which is getting created in US is going to be a multi-year process. But when I look at numbers from TCS or the commentary from Infosys, it has changed in between quarters. So while the big picture argument is that the relevance and the importance would be there, but in the near term, when you see so much of volatility in IT, it just makes you wonder that is that the right sector to bet on?
So if we come back to sort of considering the situation in TCS's results, not only are they reporting operating margins of around 25%, actually operating margins 25%. The staff, the input cost pressures there, the wage inflation pressures that we were seeing last year are gone. You're seeing YOY top line and bottom line, YOY and local currency doing around 15-16%. But most importantly, Nikunj, you're doing, I think, around $10 billion of deal wins. And more generally, if I look across the IT services industry, the deal wins number, deal activity is actually quite solid. What these companies are rightfully doing is they're telling you that, look, 4 banks have gone bust in the Western world in the last month. And naturally, therefore, Western CEOs are circumspect about what they're going to do in the next couple of years. And these are high quality, honest companies. I think TCS and I also reckon Infosys has similar sort of DNA. These are high quality, honest companies, and they're tempering down expectations of the future. You and I all just have to use our common sense and say, if we expect Western banks to keep bust ad infinitum, then obviously life gets difficult for the Indian IT services companies. But I don't think the Western bankruptcy situation for big banks is a permanent situation. Once the Fed starts cooling off rates, the whole mark to market around their bond portfolios fades away. And the long-term trajectory that we have seen from TCS, Infosys, I think we get back to that. So the migration to clouds isn't even 1/3 done for the Western world. Their issues, the big global companies' issues with IT staff shortages continue. And I honestly don't see why people get so worked up about quarter-to-quarter guidance from companies that have proven themselves over 20, 30 years. You got structural trends with clean companies, well-run companies. Go forth, stay invested and make money for him. Consistent compounder stays a big position. Quick disclaimer, all of these companies, I own them through Marcellus. My parents own them through Marcellus. And 10,000 clients own them. And we have fairly substantial positions in all the companies that I'm discussing.
Saurabh, hi, morning. Intrigued to know whether there are any new entrants to the rising giant portfolio. That's where I see the most interesting and upcoming names.
Right. So no, we haven't added much. We're just concentrating on bulking up further. So Divi's Lab used to be only in CCP. In consistent compounders, our large cap portfolio. As I think everybody in the country knows, Divi's Labs halved last year. So through November, December last year, we increased the position in Divi's Lab very substantially in the flagship portfolio, CCP. But we also added Divi's Lab Aisha. We also added Divi's Lab to Rising Giants. Rising Giants focuses on companies with $3, $4, $5 billion market cap. And thankfully for our Rising Giants client, Divi's fell so much through last year that it became a mid cap and we added Divi's to Rising Giants. Barring that, the only other addition has been in our small cap Kings of Capital portfolio, which is a financials portfolio where we added Prudent Corporate, which is a company which provides a platform to mutual fund distributors and people who sell insurance policies to the mass affluent. I think there are around 25,000 mutual fund distributors and insurance salespeople on their platform. And we think Prudent Corporate is a straightforward play on the financialization of savings, not just at the sort of 18 hour viewers level, but also at, say, the more modest strata of Indian society where people are trying to save 2, 3, 4 lakhs a year through either mutual funds or through life insurance.
Saurabh, hi, morning. Let's also discuss some of the interesting mid-small cap names that you've got in the Little Champs portfolio. Moltec, Pack, Poshak, Tarsen, GMM, Fodler. What's the outlook? And if you could just revisit some of these stocks.
So let's just go quickly then. So Moltec Packaging, leader in mold packaging. In mold packaging is the sort of packaging you see in high-end FMCG products, quality walls, ice cream bucket. So Asian Paints, Berger Paints use in mold packaging in their more premium paint offerings. And naturally, therefore, as the paint industry grows, as the premium end of FMCG grows, Moltec Packaging is setting up plants alongside the big paint and big FMCG giants. So they have a niche in this. They're a leader in this. There's a specific technology advantage that they possess in mold packaging. We've interacted extensively with the management since we first bought a stake 4 years ago. We've seen the management raise its game on capital allocation, improve the technology, and we remain very convinced that there's a long-term future for this very interesting small cap company. Poshak is a dominant player in phosgene. So phosgene is an essential industrial chemical, as essential as chlorine. Because this was the chemical at the heart of the Bhopal gas tragedy 40 years ago, it's a controlled substance. The government does not give out new licenses to make phosgene. Poshak, therefore, is a quasi-monopoly. It tripled capacity through 2021. It tripled capacity through those years. And we bought it once we had visibility that the ROCs, the return on capital, had been slowed, had been compressed by the tripling of capacity. And we remain optimistic that as we come out of COVID, as the economy recovers, the incremental demand for phosgene will be met by Poshak. Barring Poshak, the only other large manufacturer of phosgene is a PSU, where I don't think the competition is going to be credible or sustainable in terms of a Poshak versus PSU situation. And the third company, was it GMM Fodler that you mentioned?
Fodler.
What was the third company, GMM Fodler?
Yes, GMM Fodler, that's right.
Yeah. So just also GMM Fodler, the order books in domestic glass line reactors remain full from everything that we are hearing. So we got several of GMM's clients in our portfolio. So we keep talking to GMM's clients, and from everything that we are hearing from Baroda, from Vapi, from Hyderabad, the domestic demand for glass line reactors, these are ceramic reactors within which pharmaceutical products are made. The domestic demand is strong. 55% market share globally for GMM glass line reactors. That part of the business remains strong. Profit compounding driven by the glass line reactor piece, I reckon will remain very healthy. The piece that we're doing more work on is the non-glass line piece. As GMM Zucam now are basically a multinational, I would say half of their profits now come from non-glass line reactors. We think revenue momentum is good there, but we're trying to figure out how much of a dominance, what is the strength of the competitive moat here. But if you ask me about the profit outlook here, I reckon that remains very buoyant, as it has been, to give GMM credit, as it has been for the last 3 years. I think the world is shifting away from China towards making pharma and specialty chemicals in countries like India, and GMM remains a play on that.
What's most interesting, Saurabh, actually is your global compounder portfolio. And while, of course, there are obvious names like a Microsoft and Berkshire Hathaway, that let's not touch upon. But Intuitive, which is actually a medical equipment company,
Yeah.
Hermes, I mean, clearly all the data points seem to be indicating that luxury market is not seeing any slowdown. And then tell me more about Ashlead and Hiko.
Right. So let me just cover up Intuitive. So actually the idea for this came from, our domestic flight. So whichever airport we would land in, right? When you leave an airport, maybe Delhi airport or Bangalore airport, you will see big signs saying, this is the hospital you need to visit in Delhi or in Bangalore for robotic surgery. So we came back to the office and we realized that robotic surgery now accounts for something like 80-90% of the operations that are performed in hospitals such as in Delhi, Bangalore, and indeed in the Western world. And believe it or not, market share for Intuitive in robotic surgery globally, market share is north of 50%. This is the dominant maker of robots that are used in soft tissue surgery. They have a moat around the fact that once a doctor starts using Intuitive's machines, the machine is called Da Vinci. Once a doctor starts using Intuitive's machines at the age of say early 31, 32, 33, it becomes very difficult for the doctor to change the robot, right? The older you get as a doctor, the more dependent you get on Da Vinci, and that gives Intuitive a very solid moat. Even if the doctor changes hospitals, changes jobs, he wants Da Vinci wherever he or she goes. And that's why we loaded up on Intuitive in global compounders. And as you said, as we get older, richer, as rich people globally get older, the addressable market for something like robotic surgery will only expand. And just on that note as well, Aisha, Hermes, we reckon is a similar play. The count of dollar millionaires is an unbelievable number. Millionaire, the annual count is growing at 6-7%. And the number of dollar millionaires. And as I'm sure many ET Now viewers will appreciate, especially of the fairer sex, dollar millionaires want Birkin bags. Hermes, by definition, is the monopoly provider of Birkin bags. That drives 70-80% of its profitability. And these handbags at $20,000, $50,000 become that much more desirable as the rich keep getting richer globally. So Intuitive and Hermes, very different companies, but both are plays on the global super rich and incredibly moated companies.
And she's saying Saurabh Mukherjee understands what women want. Is she getting a bag Saturday or like a next anniversary gift? Will it be in Hermes?
So is yours, by
I can't afford it. The qualification here is old and rich people. I'm getting old, but I'm not getting rich. So for me, I don't qualify the cut.
Saurabh Mukherjee. At the moment, I'm telling my better half to look at Titan. Titan is part of the founders. We're very happy with Titan.
But that's jewelry, my friend. That's even more dangerous path you've started to go on. Tanishq is more expensive than Hermes bag. Saurabh Mukherjee, you're walking on a dangerous path.
So Hermes is a very clever company.
I'm sending this clip to your wife, Saurabh. I'm sending this clip. Producer, please mark the time, 9:32. I'll send her the text that you're promising her some Tanishq jewelry.
Thank you very much.
Yes, Tanishq, Saurabh.
Yes, so we're coming back to that. Tanishq is a play on Titan rather is a play on the same dynamic in India. And as we can see year upon year, the sorts of people who watch ET Now, their salaries are going up, their bonuses are going up, their business opportunities available for them are going up. And naturally, therefore, Titan is driving 25% free cash flow compounding year upon year on the back of that. What's even more interesting, I thought, was how last 5-6 years, Titan has turned Carrot Lane into a very profitable e-commerce proposition, growing at 50%, right? So Carrot Lane makes money, real cash flow, real EBITDA, and it grows at 50-55% year after year. And Carrot Lane caters not so much to my better half, more to say my daughter's generation of women, people who are beginning their jewelry buying journey, buying say jewelry for 15,000, 20,000 rupees, and doing so online. So both the 80,000 rupees per item jewelry and the 20,000 rupees, Titan has basically created a cradle to grave jewelry proposition for affluent Indian women who are going to work, earning money. And it's difficult to see which local jeweler can take this company on. I think at a PAT level, EBITDA or PAT level, Titan makes 4x the profits of its nearest competitor. And each year, I reckon that gap is widening. So as a play on Indian affluence, difficult to see of more. In the last 20 years, Titan has created 1200x shareholder wealth. Even I fell off my chair when I realized that. So 1200x shareholder wealth, free cash flows would have gone up to 100 to 50x. but unbelievable creation of wealth by this company from Bangalore.
All right, Sir Mukherjee, it was great to have you. Learned a lot about Hermes and handbags. Thank you very much for enlightening me, at least on that front. Tanishq, I already
Thank you,
know,
Ed.
but thank you very much. I'm going to change gears and move away completely from markets and talk about sugar. That's one sector which, irrespective of what is happening in the world, is at a multi-year high. Sugar prices are at a multi-year high. Will this sustain? Now let's take that conversation forward with Sanjoy Monty, DG with ISMA, Atul Chaturvedi, Executive Chairman with Sri Renuka Sugars. Good morning, gentlemen. Thank you for joining us. Atul, first let's understand that sugar is in a global cycle. Now I can talk about sugar cane demand high in India because of ethanol blending, because of this entire focus on alternative fuel sources. But globally, what is powering the sugar cycle?
In fact, globally also, if you see, Asia has been the biggest culprit in terms of lower cane production this year. India is down by almost, if we take our numbers, we are penciling in a production of about 32.5, which last year was closer to 36. China is down by about another million tons. In fact, Thailand is also down by about roughly 700 to 800,000. And Europe is also not in the pink of health. The only silver lining in all this sugar or cane production in the world is Brazil. But Brazil is struggling because of the continuous wet weather, which is actually hampering production. And the other thing is that Brazil this year has been blessed with a fantastic soya seed crop. In fact, their soya production this year is closer to about 155 to 156 million tons. And the ports in Brazil, they actually prefer soya to sugar, because that's a much easier commodity to handle and probably gives better prices. So with the result that production in Brazil has not taken off big time, though the crop is very big, closer to something like 600 million tons, the world is short of sugar because of the delay in the Brazilian harvest. And India has, in any case, capped its export at 6.2 million tons, which is practically over and done with. So the world is awash and world wants sugar. And the only place which can probably feed the world is Brazil. And at this point of time, Brazil has its own share of problems. So that is what is giving a spike to the international sugar scenario. And a part of that is now also getting translated into India, because Indian values for far too long had remained very, very subdued. Even today, when the values have gone up marginally, we are practically lower than the cost of production and the cost of carry. So I think there's some room still for the prices to move northwards. Yep.
All right. Sanjoy, let's get in your take as well. Would you concur with that assessment of Mr. Chaturvedi in terms of where prices could potentially be headed?
Well, quite clearly, it's absolutely on the right track. Let's step back. The prices of sugar have been depressed. We have the lowest price of sugar in the world. Just to give you a sense, the price in Brazil is at 42, in Thailand is at 48, at EU is at 130, and Bangladesh, our neighboring country, is at 106. So we have seen some increase in the ex-milk prices, which is helping to make the sector a little healthier. But let's just be clear that our prices have been depressed and our prices are lowest in the world. We have been, both associations and the state have been writing to the central government to try and bring in a change in the MSP. This is welcome, but this is really not going the entire distance. Atul did put out that we are still below cost of production, and I'll just give you a few small numbers. The current price of cane is at 33 at 11% recovery. Take a small cost of conversion at 5, that takes us to 38. So even at the current price of right now, let's say an average price of 35 rupees X mil in India, we are still below the cost of production.
Right. But Atul, when do you expect an uptick to come by in prices?
It already
Well-
is moving northwards. In fact, once the summer sets in, the demand for beverages definitely picks up. And I'm sure the market is probably sensing that. And coupled with that is that Indian values during the peak crushing period were pretty low, and a lot of sugar got exhausted. So we are now into the lean season, and the only place where sugar is still being crushed is probably UP. As far as Karnataka and Maharashtra is concerned, we suffered from the sudden death syndrome. In fact, we were expecting very good crop, but then suddenly it collapsed because of inclement weather, and then we ultimately landed up with Maharashtra losing more than 2 million tons of sugar, and Karnataka also losing roughly about slightly less than 500,000 tons of sugar. So all those things put together is bound to put a little bit of a pressure on the domestic values. And there's no reason why we should continue to pamper the urban consumer beyond a point. I think in the past also we've seen prices of 38 and 40 selling in the domestic market, ex-mill. So I think government should also be quite comfortable at even 38, 40 rupees of levels, ex-mill levels. So that we are hoping should come about in the foreseeable future. Yeah. Back to you.
Mr. Monti, I go back to that very basic question, which is that महंगी चीनी is bad inflation. At some point in time, the government of India, which has intervened in rice, which has intervened in wheat, which has also intervened, in steel, could be forced to intervene. While the big picture, what you're saying is absolutely true. Sugarcane shortage, seasonality, food being, sugarcane being diverted for fuel. But ultimately, if sugar prices they go higher, it will sound something which I don't like, you will not like, nobody will like, महंगी चीनी.
Well, let's just see it in full perspective. If the retail price that's held steady for 40 rupees has gone up by 2 rupees to 42, let us see the impact on a domestic household. The average consumption of sugar in a household is about 5 kilos. And if it goes up by 2 rupees, the net impact on the household budget goes up by 10 rupees. It's not significant at all. So we must be absolutely clear that the intervention on price on retail will not be required simply because it has a negligible impact on a household budget. So there's really no cause for worry. And fortunately, we must look at the entire scenario. In India today, we are very well on supplies. So we'll not have a shortage going forward that the prices will increase because of a shortage. And that's an important fact that we should be aware of, that any price rise is not going to be driven because of a shortage syndrome. We have enough supply. In our planning, government has done an excellent thing. From the production that we do, our first allocation is for domestic production. After that, we do diversion for ethanol. These are two priority areas. And only post that do we actually put out any exports.
Okay, Mr. Monte, you got a nice little debate going in a studio when you said the number of Indian household consumes 5 kg. You did not quantify. Are you saying that Indian household is consuming 5 kgs of sugar a month? That means we are eating a lot of sugar.
If you take an average household with 5 people, 4 or 5 people, that's 1 kilo a day. And if you see, you split it up in 1 kilo per person, you split that into 30, you consume less than 30 grams of sugar in a day. And if you consume 3 cups of tea across, it's nothing. And it's very, very interesting how if we globally are below world average. Global average is 40 kgs per person annually. We are woefully short. We are at 19 kilos. So it's not anything that's, a number that has to worry. And we all require that bit of energy in a month to keep us on our feet.
You've got all of us thinking 5 kgs a month is if my family is consuming.
We really need to bring it down.
Yeah, I mean, I'm just saying, oh my God. Okay, Atul, yeah, you want to say something?
No. What I'm saying is if the family is 4 persons, then you'll only consume 4 kgs, not 5. Another nucleus family concept is coming in.
Okay. Atul, but where do you see the sugar capex moving? Ultimately, it just comes down to the fact that are sugar companies investing more in basic sugar manufacturing capacity, or they will continue to invest more in the ethanol blending capacity, because that's where the visibility is there. You tie in with a government contract, you're locked for multi years, you can plan your capex because the bank will be happy to give you the loan because that capex in a sense has got a backstop because of a government contract.
No, definitely. In fact, the sugar companies are ramping up their ethanol capacities. Even if we take the company I take care of, our capacity used to be about 720 kl per day, which we've ramped up to about 1250 kl per day. So that's because we are punting big time on ethanol, and we feel that the way forward is ethanol. And I go to the extent of saying that we should stop calling this as a sugar industry. It is more an energy industry or energy company. So that is where the actual big money is going in. And as far as ramping up of capacities is concerned, I think that's not happening, because in any case, our capacity utilization is not all that great. For example, in Karnataka and Maharashtra this year, maximum number of days the sugar factories ran was only about 120. So UP may be slightly higher than that. But then when you're running a company factory for only about 120 days, so it doesn't make sense to ramp up the crushing capacity. But definitely if the cane keeps growing, we will definitely have to relook. But maybe then the industries might not run for 120 days. They might actually run for 130, 140. Or like in UP, they run for about 180, 190 days. So I think ramping up of capacity in terms of crushing may not be the way forward, but definitely ethanol is the way forward, and the country needs it big time. In fact, I was reading the minister's statement the other day that this year for 11 months, the import bill for crude is something like US $211 billion. That's a whopping number. So I think the writing on the wall is very, very clear.
All right. It's been a pleasure interacting with you, gentlemen. Thank you so much for giving us an insight as to where sugar prices are headed, the outlook, global factors, and of course, how much sugar we actually consume in an Indian household on average. Time for a quick break right here on the show. Tell you what, we've got the management of ICICI Lombard lined up next. Come right back to hear out that discussion. Welcome back. 17,644 on the index, quiet for the broader end of the market. We've got Gopal Balachandran, who is the CFO as well as Chief Risk Officer at ICICI Lombard, here to talk numbers. Thanks so much for joining in. Now, off late, you've been focusing on retail health. Is the growth achieved in the retail health space sustainable according to you? What kind of guidance do you have for FY24?
Yeah, I think that's a great start. So if you look at, for us, retail health has always been an area of opportunity, as what we have been talking right through the last several quarters. And we continue to kind of make investments in adding headcount, who would be essentially health agency managers for ICICI Lombard. And they would obviously go out to the streets and possibly get incremental agency distribution. And what we had kind of talked to the market was, obviously, we want to see these investments play out in terms of incremental growth. And we are happy to note that when you look at, let's say, for the last couple of quarters, the growth for ICICI Lombard on the retail health segment, in fact, has been better than the overall industry numbers. And we are also kind of, the last 4 out of 6 months, in fact, growing faster than even the standalone health companies. So from an ICICI Lombard standpoint, we are quite excited. And health clearly is an area of opportunity. As you would see, for example, health is by far the largest contributor to the overall revenue for the industry, even as we speak. So hence, we are staying invested in that particular segment of business. And obviously, we would want to look at increasing our market share as we look forward.
Right, and as you switch focus to health, you currently have a small piece of the market. The largest player holds a dominant share. Can this significantly then contribute to your business going forward?
So absolutely, I think if you look at as a company, ICICI Lombard has got a market share of 8.2%. But if you look at maybe the retail health space, particularly in the indemnity side, we would possibly have a market share of maybe 3%. And that's clearly the opportunity that one sees. And what I just mentioned, clearly the investments, what we made, for example, last year we talked about adding about 1,000 people on the rolls of ICICI Lombard, who in turn will, as I said, go out to the streets and possibly get about 15 to 20,000 agents. We are on course for that particular incremental agency distribution in terms of acquisition of distribution. And they in turn, as I said, early signs are extremely kind of successful in terms of us growing faster than even the standalone health companies. And in terms of the relative comparison with maybe the largest player, obviously there is a catch-up that we have to make. That's predominantly because we started focusing on this segment only since the last, I would say, seriously in the last 3-4 years. And clearly the roadmap for us is to look at increasing the market share in this particular segment by both coming out with new products and at the same time staying invested in expanding distribution.
And on the motor OD side, when do you expect to see growth starting to recover, and what will be the factors that you would look at which will help you drive the growth?
No, so motor is the preferred segment for ICICI Lombard in terms of the opportunity that one sees. If you look at the thought process, what we have been kind of driving is, it is not that we don't want to kind of grow, but the market is at this point of time staying at an elevated levels of competition. And in the backdrop of competitive intensity is where we have been a bit guarded, particularly in the private car segment. However, when you look at us in terms of growth in two-wheeler and commercial vehicles, both of them have kind of done reasonably well. So that's how we clearly look at positioning in terms of growing this particular portfolio. On the demand side, in terms of the market, I think private car demand is quite solid. Even the commercial vehicle segment has been doing quite well. It's the two-wheeler segment which is still not completely out of the woods, which hopefully we expect maybe in the second half of this year, things coming back in terms of growth. From our standpoint, I think we are kind of staying invested in, as I said, building distribution even on the motor agency front or other channels of distribution in terms of, let's say, dealership access or the capability that we have created on the digital side as well. And already we are seeing some early signs of a bit of competitive intensity getting easing. And hence, to that extent, we believe we are in the right spot to possibly capture this opportunity for growth.
So is the combined ratio target of 102% by FY25 comfortably achievable? What factors were you to look at if you were to overachieve? And would you be able to consistently clock in this 17% ROE?
Yeah, I think, so your question has two parts. Let me address the first one in terms of the combined ratio trajectory. From an ICICI Lombard standpoint, as we have been talking through, not just now, even at the beginning of the year, as I mentioned, and maybe even 1 year back, when we did the transaction with Bharti AXA, even at that point of time, we had indicated that the combined ratio trajectory for us will see a gliding path from the current levels at which they were operating at to maybe, let's say, 102% over the next 2 years. So at this point of time, we are not changing any of that thought process of bringing down the combined ratio to 102 over the next 2 years. Some of the levers obviously will be the kind of business mix that one wants to write, the price increases that one is able to possibly exhibit on some of the portfolio segments, again from a risk underwriting perspective. And thirdly, as what I indicated, we are kind of carrying out a lot of investments, particularly on building some of the franchises. Now, some of those investments are already, as I said, seeing early signs of success in terms of incremental growth. So that should also kind of bring in efficiency in operations. And finally, we are kind of as a company doing a lot of thrust and focus in terms of building efficiencies in claim service. So there are multiple levers that are available with us. And at this point of time, we believe we should be on our course to possibly get to a trajectory of 102 over the next 2 years. Having said that, obviously, we will wait for how the market kind of responds, because if you look at the industry combined ratios are currently operating in the range of, I would say, between 116 to 118%. So in that backdrop is where we are saying that we would want to see a glide path from 104 to 102 over the next 2 years. So that's in response to the first one. On the second part of your question in terms of the return on equity, there again, I think to the market, what we had spoken about was a sustainable ROE, which will be in the high teens, which will be in the range of about 16 to 18%. And if you would have seen maybe the exit return on equity that we had seen for the current year, we were at about 17.7%. So hence, we are pretty confident in terms of the ROE trajectory as well, kind of staying in that high teens range within that 16 to 18% bucket.
Right. The other thing I wanted to understand was, that Bhargav Dasgupta has been leading the organization, since 2009, but his term ends in 2024 May. He's been prolific in leading ICICI Lombard. Could there be a risk of a void in leadership here?
So I think ICICI Lombard are institutions, and therefore to that extent, there are enough, I would say, leadership bandwidth that exists both internally as well as within the group, and the board is seized of this particular matter. And succession planning is something that we actively kind of involve, not only with respect to CEO transition, but even across layers of management. One definitely looks at succession planning very, very actively. Having said that, the time period that you kind of indicated is presently in the draft form that the regulator had put out to say that the CEO term will be possibly be for a 15-year period, which is what Bhargav term possibly comes to an end in May 2024. I think we will have to wait for further regulatory guidelines in terms of how that particular thing evolves. But having said that, as I said, the board actively involves and engages in succession planning conversations. And in terms of leadership depth, both within the institution and within the group, I think there are enough capabilities that are available. And maybe at an appropriate time, as an institution, we will come back to the market and make necessary announcements as required.
In Q4, your OPEX had moderated slightly. Just help us break it down for us, and what is the level of CAPEX that you've been affronting?
No, so I think clearly when you look at operating expenditure when you look at, rather than just looking at just operating expenses, you have to look at both the overall expense of management. In general, in periods when you see a relatively lower growth, obviously corresponding to that, you also see a relative lower cost of acquisition. And for Q4, as you have seen for us, the growth was slightly moderated, and hence to that extent is also a factor in terms of the operating expenses being relatively lower. Having said that, I think if you look at more the overall thought process in terms of how do we want to drive going ahead, the combined ratios to the streets, we had kind of talked about at the beginning of the year to be around 104% by the end of the year. We are pretty much around that. And over the next 2 years, we would want to see this combined ratio go down to a trajectory of about 102%. And a key influencer in terms of achieving that particular combined ratio objective will definitely be expense of management as one of the levers. And at the same time, we will also continue to focus on claims efficiency as well. Both of them will kind of aid in the thought process of bringing down the combined from the current 104% level thereabout to 102 over the next 2 years.
And your loss ratio has seen a sequential jump, and you've also got Motor OD, which has seen a jump on a full-year basis. Do you think that this pressure will continue?
So as we keep saying, I think our business has got a lot of cyclicality attached to it. And hence to that extent, one should not really necessarily compare loss ratios, particularly on a quarter-on-quarter basis, because there are a lot of factors that gets influenced when you look at a particular loss number for a given quarter. The same number possibly when you would have looked at, let's say, for quarter 3, you would have possibly seen an improvement in the loss ratios for some of the segments that you referred to. A better way will be to look at more on an annual basis, and that's far more sustainable if you were to look at in terms of the way forward. Having said that, I think we keep evaluating in terms of the product mix that we want to kind of drive in terms of the underwriting objective. At the same time, some of the segments, wherever it warrants a change in pricing, we would not shy from taking a price increase. For example, on the retail health, in the month of February, we effected a price increase of almost about 19% on the renewal book of that particular segment. Similarly, motor, the segment that we spoke about, is also a segment where we have effected a single-digit price increase as we speak, particularly in quarter 4 onwards. So hence, to that extent, a better way in terms of the loss number is more a full year number as compared to looking at more on a quarter-on-quarter.
Right. Great to have you today on the show. Thank you so much for taking the time out, Gopal, and speaking with us today. That's the view coming in from the ICICI Lombard management. Let's now talk about rubber prices, which are clearly climbing the ladder. And how is it that raw material prices are going to hurt or impact the earnings for JK Tyre? Let's bring on board Anush Kathuria, the president, India at JK Tyres and Industries, joining in on the show right now. Anush, hi, good morning. Great to have you today on the show. Tell us how the rubber prices have been moving, because as I understand, there has been a steep climb, and how is that likely to impact your business?
Good morning. Regarding rubber prices, we need to understand that when you make a tire, you use natural rubber as well as the synthetic rubber. So, and both natural rubber and synthetic rubber are sourced indigenously and also imported. So definitely the pricing that we are talking about, natural rubber, we have seen a softening in the prices when we talk about the financial year that we just closed. In quarter 4 we saw. Yes, there are certain indications that going forward, the prices may again go up. But if you talk about the imported part of it, there the prices were almost flat. Synthetic rubber definitely has been had seen an increase in the previous financial year. But with crude prices now coming down, we have to see that generally the effect is shown at a lag. So we will have to wait and watch on the synthetic rubber side.
Components which are important raw material. One is rubber and second is carbon black. If one looks at the second component, which is carbon black, as per percentage of total sales, how much is that?
In the composition, if you talk about what is the weightage of, in the total value, it is somewhere around 15%.
In rubber and carbon black, we are looking at least 50% of raw material cost broadly. Okay.
That's right.
And this 50% cost, same time last year versus now, is down how much? Because these are the two moving parts. I mean, you'll appreciate the spirit of my question.
Yeah, so carbon black, if you talk in specific, the prices have gone up and they have been there. They have not come down as compared to what has happened on the rubber side. But as I clarified earlier, even in rubber, the natural rubber prices have softened in quarter 4, especially the indigenous ones. But the synthetic rubber prices have been on the increase. But now with crude coming down, we expect that they will also come down accordingly with a lag.
So which means that if prices they come down, would you be able to retain the pricing power back, or you would be forced to pass it on? Because for last 2 years, tire companies have only increased prices. This one, next 6 to 8 months, if prices continue in this trend, would you be cutting prices?
See, one thing we need to understand that except the quarter 4 of last financial year, if you take the 7 quarters before that, the raw material prices were continuously going up. And we had the overall weighted average increase was over 40%. Definitely, while we took a lot of price increases, but we were not able to pass on the entire impact of all the cost increases. So there is a residual impact as we speak. So in this scenario, I don't think so that there is any opportunity to reduce the prices in the market.
Okay, and what about the outlook in terms of your margin performance in Mexico? The lower margin performance really impacted the profitability there. So walk us through the outlook in terms of the factors that are at play. Are you now seeing an improvement?
Yeah, we are seeing an improvement. The overall demand over there, whether it is in the North American market or even in Latam, it is expected to come back, and we are again making our plans accordingly.
Progress on the capex plan, 790 crore rupees had been announced. Which facilities, do you plan to get the new range tires manufactured in, and have you upped your capex plans?
Yeah, we had announced this. Actually, the overall outlay of capex was 1100 crores, which included the first phase of debottlenecking, which has been completed. So the remaining part, which is the 790 crores, there are two expansion projects. One is in our Banmore plant, which is near Gwalior. That is for the passenger car radial tires. Those will be, that program is underway and is expected to get commissioned by the second half of the current financial year. We should start getting the output from there. That is around 530 crores. The remaining 260 crores is for the truck and bus radial tires. This expansion is being done at our Luxor plant in Haridwar. And this again is being progressed very successfully. And it again is expected to get commissioned in the second half of the current financial year. So these are the two ongoing programs. We are definitely evaluating if there is any further need for expansion that we would have to take up in the current year.
Okay. I've been wanting to ask tire companies this question, that everybody in the auto industry is talking about ICE engine becoming EV engine, which means ICE car will become an electric car. For the tire industry, tire same hai, tire bhi badlega?
So definitely the tire would undergo certain changes. There are certain specific requirements when it comes to electric vehicles, especially in terms of the coefficient of rolling resistance. So low RRC tires are definitely going to be required. We are also, because they are more energy efficient, and that helps the electric vehicles have a higher range, because with the same charge they can go a longer distance if the RRC is lower. That is one. The other is that the noise levels that come from the tire have to be very different when it comes to EVs. The pattern, the tread, wet grip, dry grip, all these things, braking distances, everything has to be different. And we need to keep in mind that the battery weight actually increases the overall weight of the electric vehicles. So accordingly, we will have to, there are certain trade-offs, but we will have to design tires which are specifically meant for electric vehicles, whether it is the commercial range or even in the passenger range. And we have been doing this. We have been working very closely with the manufacturers, the OEMs, and we have successfully developed tires for the intra-city buses. In fact, in Delhi, most of the EV buses that apply are running on our tires. We're also launched recently in the Ranger series, the HPE, which is meant for, again, electric vehicles or passenger cars, and working with a host of 2- and 3-wheeler manufacturers who are venturing into the EV space. And we would be kind of very soon, introducing those tires for the EV vehicles.
Thank you for taking time out and joining us and giving us a view as to how things are shaping up at JK Tyres. Time for a quick break with news that the index is currently quoting at 17,629. Stay with us for more market chat.